If you are someone who's planning to buy a house and wondering if the house prices will decline in 2024, then in this video we will analyze the economic factors that will affect the house prices in 2024 and discuss what is the right thing to do for someone who's looking to buy a house. My name is Kanak and welcome back to my channel. If you haven't already subscribed, then subscribe to my channel for more informative content. So let us go back in time and understand what caused the housing prices to collapse in the 2008 financial crisis. During the 2008 housing bubble burst, as the mortgage rates increased, a large number of people could no longer afford their increased monthly mortgage payments and as a result defaulted on their mortgage payments. This resulted in a large number of foreclosures and people sold their houses well below their purchasing price, which caused the median house prices in the United States to decrease by $50,000 from $260,000 in 2007 to $210,000 by 2009. To tell you an interesting fact, the housing prices in United States have already decreased by $50,000 this year in 2023 from median house prices of $480,000 to $430,000. Now the important question is, will the house prices continue to decline in 2024? So, for house prices to decrease, the supply of houses in the market has to exceed the demand for those houses. And this can happen only when a large number of people start to default on their mortgage payments and increase the supply of houses for sale in the market. The mortgage payments can become unaffordable when either the mortgage payment increases beyond the household income or the income of the household decreases due to unemployment. Now we will analyze two economic indicators that are directly linked to monthly mortgage payments and the level of employment in the economy. If the central bank raises interest rates, the mortgage rates increases, making the mortgage payment unaffordable. Secondly, if the unemployment rate increases, more people will lose their job and they can no longer make the mortgage payment. So, central bank interest rates and unemployment rates are the two key economic indicators that will help us understand the direction of the housing market in 2024. First, let us look at the impact of mortgage rates on house owners. In 2001 and 2022, the majority of people either purchased or refinanced their houses to 30-year fixed mortgage rates, which means their monthly mortgage payments will remain fixed for the next 30 years and their payments will not be affected even if the mortgage rates increase further. This means existing owners of houses are not exposed to the risk of mortgage rates increasing, and thus the mortgage rate increase will not result in foreclosures. Now, the second risk that could cause default on mortgage payments is if unemployment rate in the economy rises. However, the unemployment rate in the month of October 2023 is still at historic low of 3.9%. The unemployment rate directly hinges on the interest rate policy of the Federal Reserve. The Federal Reserve's interest rate policy would be the key factor that would decide whether the economy enters recession in 2024 or not, because interest rates directly affect businesses in the economy. If the central bank raises interest rates, the cost of interest payments for businesses will increase and also businesses will borrow less. These two things combined will have a negative effect on the job market. As of fourth quarter of 2023, the Fed rates are at their peak since the bottom of COVID-19 pandemic. Although the inflation has cooled down to 3.7%, it is still above the target inflation rate of 2%. Usually, this last leg of inflation is very sticky, and for the central bank to start lowering interest rates, the inflation will have to cool down faster to 2%. But the good news is inflation is not in the extremely dangerous zone of above 7%. So the probability of central bank raising interest rates is extremely low. I believe the central bank will continue to hold the interest rates at the current rate until the inflation reaches below 3% and then it will start to slowly lower the interest rates, which keeps the probability of recession a very possible likelihood. And if the economy enters a recession, then unemployment rates will rise and we will see foreclosures on housing, which will cause the housing prices to decline. Another thing to talk about is that often in the housing market, house price decline is not the only way the housing market corrects itself, but more often the housing market corrects itself by staying flat for a very long time. And if the housing prices do not rise for a very long time, you effectively lose your money on your investment. So to summarize, if inflation does not cool off below 3%, the central bank will continue with its high interest rate policy, which can push the economy into recession in 2024. And if the economy enters a recession in 2024, the unemployment rate in the economy will rise, leading to a lot of foreclosures in the housing market. And as the foreclosure increases, the supply of houses will increase, causing the house prices to fall from its current level. The second possibility is that the investor who buy houses now might not see price rise for a very long time and basically lose out on their returns on their investment. While it is nearly impossible for an individual to exactly predict when the housing market will hit the bottom, but the best course of action for someone looking to buy a house would be to closely track central bank's interest rate policy and wait until the central bank starts to lower interest rates, because that's when the economy will start to take off again along with the housing market.